Did Papa Powell pull off the soft landing after all? Has the Fed done the impossible? And what does it mean for your bags? Well, the Federal Reserve has been walking that fine line between balancing its dual mandate of 2% inflation and economic stability ever since the first rate rise happened in the USA back in March 2022. Yes, it's really been that long. It feels like ages because it has been ages. But signs are now pointing to the unthinkable. The Fed might actually have done its job to bring down inflation whilst avoiding a recession altogether. So in this video, I'm going to break down the bullish indicators that are pointing to a spectacular soft landing. But, is it too little, too late? With rumblings that a recession is still coming, I'll be giving you the counter arguments so that you're prepared, well, for the worst if it does happen. And stick around to the end of the video, as of course be discussing what all this means for your bags. What you really want to know, obviously, but we need to get the juice, right? The meat of the information first. So let's talk about the signals that are pointing to a Fed soft landing. U.S. inflation isn't back down to 2% annual target just yet. Some indicators, some different organizations counting inflation are saying that, but not the Fed themselves. Core inflation, which is seen as the more important metric as it indicates what's happening to food and energy prices, is at its lowest level, though, since April 2021, currently at 3.3%, with headline inflation sitting at 3%. Of course, this doesn't mean prices are falling year on year. It simply means that prices are rising at a slower, more acceptable rate. But it's a massive reduction from the rate at its peak of 9.1% in June 2022. And finally, there is some deflation showing up on the monthly inflation rate too. In June, for example, prices fell by 0.1% in the first month-over-month fall since May 2020. Not a big reduction, but a reduction. And the Fed is achieving this reduction in inflation whilst still growing the economy. The ultimate hat trick. Even with high interest rates still in play, U.S. GDP came at an annualized rate of 2.8% in Q2. What? That's crazy and higher than expected. After a lackluster 1.4% growth in Q1, the pickup in growth alongside falling inflation has shifted the sentiment to a more bullish stance for the economy. And if that wasn't enough, the dreaded inverted yield curve, it's about to uninvert. An inverted yield curve happens when short-term bonds end up having higher yields than long-term bonds, the opposite of what is supposed to happen. It's usually measured by the rates on the 2-year and 10-year bonds. Now, once the yield curve inverts, it's a signal the economy will contract and will be at risk of a recession, with one typically following within 6 to 24 months later. April 2022 was when the yield curve inverted, and since that time, it has been the longest yield curve inversion period since the 1970s. And it's kept investors on the edge of their seats. What's going to happen? But no recession has materialized. Yet. Now, the yield curve has reached the closest level to reverting back up in 9 months. In the last few weeks, the yield curve came just 14 basis points away from uninverting, which is the closest level since October last year. So right now, the signs are pointing towards interest rate cuts. The Fed has to act at some point if they want to avoid a total disaster. But they're not doing it because something has broken, which is important to point out. They're doing it because it's safe to do so without breaking something. Think about that for a second. Whilst the Fed has held interest rates again at that 5.25 to 5.5% in July, Fed Chair Jerome Powell has signaled that rate cuts could come on the cards at the September meeting if inflation moves down quickly or in line with expectations. So if you see a hot print, aka higher than expected for the next CPI print, bad news. Rate cuts coming outside of a recession, by the way, historically bullish. In a recession, bad. But is this just the calm before the storm? Now, before I break down why a recession could still be on the cards and we have to be wary as investors, I want to take a quick second and let you know about the Wealth Mastery newsletter. This is your weekly guide to the cryptocurrency markets. Our readers love it. I'm sure you will too. And here's why, because every single week, my team of researchers and I, we help you not just stay ahead of the curve, but also help you save your time by finding you the latest and greatest insights on altcoins, meme coins, DeFi, airdrops, charts, and much, much more. You can join our 135,000 plus weekly readers for free. Link in the description on YouTube or the pinned comment over on X. Now, regardless of how things may seem, and they seem pretty good right now, the R word just isn't going away. People keep talking about it. When the yield curve does finally uninvert, That's probably when you'd expect a recession hit. If inflation continues to go down, the Fed will cut rates, declare the job done. But what if the recession is still coming? It's simply just been delayed. With bank savings being higher than what you'd usually expect to see at this point in the cycle, it means that many people probably have not yet felt maximum pain. So the question becomes, are we late or are we early in this overall business cycle? Well, unemployment levels will always be a strong recessionary indicator, and unemployment in the USA is unfortunately on the rise. Unemployment claims for the week ending July 27th increased by 14,000 to 249,000, which was above the expectation. It's the 10th straight week of levels above 220,000 and the most since August last year. So the labor market is continuing to cool down, which is no surprise given the crazy amount of layoffs that have happened over the past 18 months. Businesses have felt the pain, not just consumers, but given that changes to interest rates take time to filter into the economy and into the market, of course, there's still the concern that the Fed has simply overdone it with the rate hikes that have been too high for too long. If this upward trend in unemployment continues, then the Fed may have to cut more aggressively than they're letting on right now. And if inflation ticks up again due to increased geopolitical tensions in the Middle East or wherever else, then that would really back the Fed into a corner, knowing that if they don't cut soon enough, chaos happens. If they cut too soon, chaos can happen. So it could still be too early to declare a victory for the Fed. The macroeconomic picture is anything but clear right now. There's so many counter indicators, it's nuts. And gold has already sniffed this out with its price jumping to a new all-time high of $2,500 per ounce. Shout out to my gold bags, by the way. So now let's talk about how Bitcoin will be impacted by all of the above. Of course, the reaction to a likely rate cut was for Bitcoin's price to dump. Classic Bitcoin. Price always does what you least expect, doesn't it? But Bitcoin won't stay below its current all-time high of $73,000 for that much longer. And here's why I believe why that's going to be the case. Global liquidity is on the rise after hitting a new all-time high of $94 trillion in June, and this thing is just getting started. The global money supply still hovering around the cycle lows, suggesting there is a ton of money printing upside to come. And with more money hitting the market, the price of Bitcoin tends to rise. The U.S. national debt hit $35 trillion, growing at a rate of $1 trillion every 100 days, about $3.3 trillion a year. It's wild. It's wild to even imagine where we end up at the end of this cycle. But one thing is for sure, more money means cheaper debt. Cheaper debt means expansion. Expansion means more money will flow into the assets. So a rate cut in September would be extremely bullish for Bitcoin. On top of that, Goldman Sachs CEO just told CNBC that Bitcoin could serve as a store of value, just like gold. Guess he heard Larry Fink, who also has been saying basically the same thing. Everything's now starting to fall in place. We're approaching the peak of the everything bubble, and the next move up, we'll see a new all-time high for Bitcoin. Cycle top, probably not super far away, 6 to 8 months, maybe we push it a little bit longer. Maybe I'm not being bullish enough. It's only a matter of time. And Bitcoin whales, they know this, which is why they have added over 84 freaking thousand Bitcoin in the month of July alone. I mean, come on, guys, come on. So make sure you grab as much as you can before the train leaves the station. ETFs, whales, countries, political certainty, all this crazy stuff. Maybe it's only a matter of weeks before prices really start moving based on the anticipation of those rate cuts coming in September. Bitcoin can make a new all-time high much sooner than a lot of people anticipate, or it might be longer. Bitcoin has a way of screwing us over like that sometimes. Now, let me know what you think. Has the Fed truly done it? Did they pull off a soft landing? Will they be able to reduce interest rates, pump markets, and not have a horrific recession? Or is this all just us rearranging the deck chairs on the Titanic? The Great Depression is coming. No one is bearish enough. It's all going to zero, and we need to start repenting now for our sins. Let me know down below in the comment section. Thanks for watching. I'll see you next time.